My name is Jeremy Goldschmidt, and I'm the founder and CEO of Rent Better. I'd like to thank all of you who are here today for joining us for this session. Obviously, I know that there's plenty of other things going on in the world at this time, in your day, in your lives. So we're always grateful for people taking time out to join us in a session. And I just, again, like to recognise the commitment that you make and the support that we have from all our, loyal customers and hopefully new customers who do use Rent Better on an ongoing basis. We're a platform which is designed by and for self-managing landlords to drive a lot of efficiency and cost savings into the process, and ultimately we want you to maximize the return on your investment. It's why we do what we do every day, again, the support and feedback from our customers is really important. And part of that, and I guess part of why we run these sessions, is that we will regularly be asked by our customers or by people who are hopefully to be our customers soon, what's the state of the market? What's the best time to do this? When should I consider doing that? So we always think that, the best thing that we can do is provide information to our customers and to people who are interested. And by sort of giving out that information, people are able to make more informed decisions. And we hope, it's not a sort of complicated decision at some point as well when you think about self-managing your property. There's an element of control, there's an element of interest in your own investment. I'm probably preaching to the converted of those who are here today, but we think it's definitely a great choice and something that many more Australians are choosing to do. So without any further delay, just on housekeeping, again, there's the chat and the Q&A function. So if you've got any questions, please feel free to send them through. I can see already one comment that's come through. Someone in Melbourne, as you've put it, the lockdown state. I guess I appreciate that whilst being in the lockdown state and feeling somewhat locked down, I'm very grateful that you've chosen to spend some time with us here today. So let me just quickly try and switch over to the presentation. Just going to take 1 second here while I do that. So we'll just start very quickly with market context. And again, we've resisted from putting too many charts here because if you looked up any of the major newspapers or any of the major media outlets today, you would find that the market context. Are we good? Okay, sorry about that, technical glitch. So if you looked at any of the major media outlets, whether it's newspapers or television, you'll see a myriad of charts and different stats being thrown at you. And it's because from a sort of macroeconomic perspective, if you like, the fundamentals of the economy are pretty good. And so I just, again, not rushing through it too quickly, but just wanted to touch on a few key points before we jump into, I guess, the rental market as such. But again, from the end of March, there was the end of JobKeeper, and there was all this doom and gloom leading into it that the world was going to come to an end. I think from the banks to the government to most small businesses, there's generally been sort of a positive feeling that it's actually not left people. I mean, obviously there are some people out there who may not have be in the best position, but as a result of the end of JobKeeper, I think there's fewer people in a worse position than expected. And when it comes to loan deferrals, you'll hear the banks sort of championing that there's, thousands rather than millions of people who are on loan deferral programs, and the economy's fared pretty well. Part of that comes from the fact that there's pretty low unemployment in this country. We're actually back to, if not better than pre-COVID levels. The government said in the recent budget that they were expecting a number beginning with 4 on the unemployment rate to come up soon over the next year. And that's a huge and significantly important factor for the Australian economy, because it does two things. One, it's actually driving up the number of Australians who are earning an income because they're employed. And number two, it's creating new opportunities locally, which is a function of that third point there, because there's pretty limited migration right now. And again, in the federal budget very recently, they talked about the borders not really opening up till 2022. You can hear almost every day, whether it's tech firms or just specialist resource companies saying they don't have enough resources in this country and they're having to start paying big bucks for people who are, highly skilled or specialists. And so that's quite a good thing, actually, because it sort of influences the point above on low unemployment. There's more jobs for the people who are here, but B, it's sort of focusing in the attention on a tighter labour market, which means incomes will go up. The fourth factor here, and it's perhaps the thing that's best for everyone, is interest rates are pretty low, and that means that there's cheap money available. And the RBA sort of signaled that they're not really looking to change that dramatically in the short term. So it means that for a decent period now, and they won't say how long, but let's expect for a couple of years, that the rates will be low and money's pretty cheap. And that, coupled with the point below, which is that there's fairly low supply for properties for sale. So money's cheap, low supply of properties for sale. And basically, until now, there was pretty high risk in the country because people were scared about COVID and what would happen. So now you've suddenly seen some of that risk come off. And basically what that means is property prices are going through the roof. And so until now, since COVID started, first home buyers were really driving that demand. And there's a few pretty good charts up there that show how much first home buyer has influenced the rate of mortgage and lending growth over the last 18 months. But it's really started to taper off in the last couple of months as investors come back to the market. And there's sort of a funny dynamic in this, right? There's low supply and there's cheap money, which means people who are out there hunting are actually going to pay more for it. And that dynamic will continue. But then you sort of see, well, what does that mean for rental prices? And, there's kind of a few options here. If prices keep going up, well, you're in a position where rental prices need to go up to catch it in order for yields to remain constant and for the return from people paying for an investment property to continue. Or alternatively, the supply comes into the market, which means there's a lot more properties available and the prices will come down and they'll sort of cool off a little bit. So we're at a funny tipping point. As you can see already in some of the data, the property selling prices have started to come down and the rentals are going up a bit. So it's sort of naturally getting to its own place. But as a market context, we're in a place that actually, if you've got a bit of capital and you're looking for a property, things are pretty good. It'll be expensive, but a lot of the market conditions are pretty good. If we just jump into the next slide, and again, we've sort of sourced everything. This comes from SQM, who are sort of quite widely known for vacancy rates, but they've just produced this chart, which you can see sort of national weekly rents are rising. The blue line relates to houses and 3-bedroom houses as a benchmark, and the sort of pinkish purplish one is all units and 2-bedroom units. And look, there's a little blip that you see in 2016, which we've sort of tried to dig into a bit further because it just looks like a data anomaly there. But the general trend is going up and to the right. And so you can see as we hit 2021, even though there was a bit of a sort of plateau in the middle of last year, you can actually see prices are going up. And of course, houses have gone up faster than units. They're bigger, so they're already starting from a higher base. But in a COVID environment where people want a bit more space and maybe have even been moving to regional, which is more likely to have houses than units, you'll see that number has gone up a bit. But units are not doing too badly. You can see that they're sort of peaking and up to the right a little bit there. If you have, just as a sort of point of interest, you can see down the bottom there a little kicker on the slide. If you've got a property that you're looking to rent out and you're looking for some pricing estimates, you can actually go to the rentbetter.com.au site, scroll down on the landing page, and you'll see a pricing report tool. And so you can just pull from there a CoreLogic or RP data report, which has sort of recent data in the area and will give you some sort of intel on recent prices. We also think just going to the property sites and sort of looking for similar properties in your area is quite a helpful way to do that because it gives you a price on the market on that day. So look, this is sort of big picture, rents are rising, but of course, location matters. And so if you look here again, this is from CoreLogic. If you look into the actual cities or major capital cities and regional areas, you'll see on the left-hand columns is all the locations. There's an actual median rental price, and then you've got time periods that it's observing. If you look at the month and quarter and 12 monthly, the ones I want to draw your attention to are in the first two rows there for Sydney and Melbourne and the 12 months column. You can see that it's actually been negative. Melbourne more so than Sydney, obviously more impacted by Corona. But if you look at the column to the left of that, The quarterly rates, again, Sydney rebounding pretty strongly, and Melbourne, in fact, over the quarter was doing well, but has taken a hit over the annual 12-month period. If you just jump down a few rows to Perth, again, you can see the 12-month period huge. Darwin, 16.5, huge. And of course, at the bottom row, there, or the second bottom row, their combined regionals at 8.6%. So the places that were protected from COVID basically have done the best and have the highest rental growth, which makes perfect sense to me. On the right-hand side in that bottom right corner there, you can see that the 12 months yield is at 3.76%, which again, it's a little bit lower, and you sort of can expect to see that that's it's gone from 3.76 to 3.5, and you can sort of see how that's moving down as a result of rental prices, which were a bit flatter but are now picking up again. So location does matter at the moment, and obviously Sydney, which is the biggest property market in the country, coming back online as a positive growth over the quarter means something, and it will start to influence some of the other trends. If we then break this down, and it's sort of the same table that we looked at before on the left here, but that's at a sort of all dwellings level. If you look at it on the right, you'll see a breakdown by houses and units. And the point of this page, if you look at the far right column, is just to say that on the sort of top blue one, which is houses, and you look at the year-on-year change for houses, it's 6.2%. If you look down at the chart on the bottom right, on the green one, which is units, and you look at the year-on-year change, it's minus 1.7%. But if you just jump up 2 rows at the quarterly, you can see 0.5% positive growth over the quarter. And so the whole point of this is to say, again, if location matters, then property type has mattered in the last year, but units are coming back strong, actually, and so are the capital metro areas, which were a little bit weaker before. So it's kind of positive news. Obviously, most people who have investment properties just on sheer number are likely to have it in a metro area or capital city. So in this sense, to see the quarterly numbers tick up a bit is quite positive. So again, I guess the summary of all of this is the sort of metro areas, capital cities, and units are coming back where they were the things that were seen as sort of less positive before. It was all about regional and houses. The others are catching up again. If we just look at sort of a different take on it, and this comes from REA, and they have some nice charts that will look at the Renters Demand Index. And it's an interesting one because it's purely based on their data. And what they'll do is they'll basically take a look at the activity that's happening on their sites and their platform, and they'll classify certain behaviors as like serious or high intent rental activity. And so it kind of includes things like the number of visits a listing gets, how many photos people look at, do they save it, do they inquire, do they contact, and that kind of creates an index for how much activity and interest there is in the market. And so this is the national view, and what's quite good about it is you can see to the right again, which is sort of the May timeframe of 2021, that number is sort of on par with the pre-COVID numbers. So it's slightly down on where it was a few months ago, but you can see this huge jump at the early 21 stage, which was kind of our first getting over the COVID period and people coming out of their bubbles. So it was a huge lift at the beginning of the year. It's sort of tapered down, but it's picking back up again. And there's, of course, been a few little lockdowns in between. So the data's not perfectly clean. Excuse me. The data's not perfectly clean. There's lots going on in between. But it is, I guess, in a sense, it's positive that you can see the market moving back up and hopefully returning to some sort of normal, or whatever normal means these days. I'll just jump to the next one. And again, we want to look at now vacancy rates. So we've looked at what are prices doing. We've looked at what are tenants' intent. What is the intent of tenants and those who are searching. And now we want to look at actual vacancy rates and what's in the market. And again, this is a national level. If we unpacked it by city, you'd see different things. But where we look at it at the national level, the purple line, again, you can see it sort of picked up, and over time, the last few years, it has gone up, but there was a big jump in 2020, and it's now sort of tapering off again to reasonably low rates. And some of that will be driven by places like Perth in WA and Darwin, where vacancy rates are super low. the metro areas of Melbourne, for example, and the central CBD have still got pretty high vacancy rates. I know Sydney CBD has still got reasonably high rates. It's dropping, but they're still reasonably high. And so those sort of places are, when you have a average of a nation, it's a pretty mixed basket. But the trend is that vacancy rates are coming down, which is obviously a positive thing for landlords. And so now we want to sort of look at if you like, what's driving vacancy rates tends to be the sort of leading indicator of it is how much stock is on the market and what's available for rent. And so this is a pretty cool chart, I find, which looks at all the property listings or all the rental listings. Again, it's national, so you have to read between the lines a little bit for your location. But what's cool about this is, you can see that the sort of volume of listings as the chart goes is sort of trending down a bit to the right. But the probably most important things is that the red or the dark red, the yellowish and the greenish area, which are kind of like aged listings. And so it's the number of listings that are 60 days or more. And you can see them sort of, again, from a early or mid 2020, it's tapering down. And whilst there are a large number of listings still in that sort of royal blue under 30 days category, that's kind of the good bucket where you want it in, because it suggests, again, vacancy rates are coming down, ads are going on, they're not being aged too long, they're sort of going on and getting taken out. And tenants are securing leases. And that's, in a sense, that's kind of the lifeblood of the market. You want that velocity through where ads and properties do go live and get, promoted through the major property sites, and tenants are responding and taking them up, and people are able to sort of, pick up a lease quickly. And look, from what we see, if I compare that to our sort of book of business and what we see on our platform daily, there was a period about 12 to 14 months ago where rental prices were starting to come down, and we could see people sort of adjusting them on a frequent basis because the demand just wasn't there. And we're starting to see the opposite effect. Obviously, it's more pronounced in places like WA and Queensland, and even the Northern Territory, and I guess Tasmania to some degree, where there's been more protection from COVID. The vacancy rates are super low and the demand is super high. In New South Wales, and again, there's pockets, and it's hard to just sort of, pick up a state and look at it with one lens. But in New South Wales, there are some areas that are really moving super quick. So there's definitely demand. And, the big one on migration that's always concerned us is that there are, as I said earlier, there's less immigrants coming into this country who are natural renters, and there's projected to be less immigrants coming into the country. So there's more people returning home from overseas, and they may have been, I'm sure everybody knows at least one person who was living in, the US, the UK, somewhere up in Southeast Asia, who said at the beginning of COVID, I'm not taking this risk, I'm coming home. And so they sort of filled the role of a lack of immigration until now. But some of those people may be returning home, and there's no new immigrants coming. So that is always a risk. We think the government's sort of starting to talk more about it and opening up policies around it. So we do think, we do definitely think that will start to drive more demand as the students and the immigration opens up over the next 12 months. So I'm just going to move here to sort of final steps here and a conclusion. I guess, what does it all mean? We sort of looked at the fact that the economic environment is positive particularly for purchasing, as interest rates are quite low. So people are going to keep driving those prices up. We believe it'll drive rental prices up, particularly as interest rates get ready to move. People will start to consider rent as a pretty good investment option, and you can see, long term, it's a pretty stable asset class. Vacancy rates are dropping. The intent of users is increasing, and listings are not hanging around that much like they were before. So we think it's pretty positive. If you owned a student home next to a university, it may be a bit tougher at this moment, but there's a lot of positive signs and indicators in the numbers. I guess cyclically, again, things will move. So what we see in this quarter and at this time is not, constant forever, but it's certainly, quite positive at the moment. Before I close out or open up to any questions, I just want to say that we've had a few of these sessions now, and we've always noticed that there are additional questions. So if you do have anything to ask after we finish this session, please feel free to email us at info@rentbetter.com.au. I'm sure you'll find we're pretty responsive and happy to help. So feel free to send through questions, comments, feedback. We're always very grateful for your support. Excuse me. And then finally, we're going to be hosting the next webinar from June the 16th, which will be a workshop. We'd love to have you join. If you haven't already registered, please do so. You can, again, contact us if you need help to do that, or you may have already seen a request offering you a chance to do that. But that'll kick off on the 16th of June. We're always grateful for your time and support, and thanks very much for joining us today. Take care.